A very good morning and a happy Friday. Welcome to today's episode of Morning Wealth. Three things that we will talk about: divided government bets push stocks higher, earnings roundup, FOMC and BOE decisions. US stocks jumped Thursday on track for their sharpest weekly gain since April as investors cheered the diminished prospects of higher corporate taxes under a split Congress. The benchmark S&P 500 rose 1.9% a day after it logged its biggest one-day advance since June. The index has climbed 7.4% so far this week. The Dow also rose about 2%. Technology shares led the charge for the second day. The Nasdaq Composite jumped 2.6%. All three indexes are on course for their best week since the period ended April 9th. Investors' anticipation of a divided government, which could make it more difficult to accomplish major legislative overhauls, including raising corporate taxes and regulating technology companies, has fueled sustained optimism on Wall Street this week. The S&P and Dow are both on pace for their fourth consecutive gain of 1%, the longest such streak for both indexes since October 1982. Sectorally, 10 of the 11 sectors in the S&P 500 were up, a contrast from Wednesday actually, when traders unwound some of their bets on economically sensitive sectors. On Thursday, companies ranging from cruise operator Carnival to oil producer Occidental to industrial giant Caterpillar jumped, with each rising 5% or more. In Europe, the optimism was also high. The Euro Stoxx 600 rose 1%. In Asia, Hong Kong led the regional gains. The Hang Seng was up 3.3%. South Korea's Kospi was up 2.4%, while China's Shanghai was up 1.3%. Chinese technology companies would benefit from a less antagonistic relationship between the leaders of the US and China if Mr. Biden wins the presidency, and that's the reason why we're seeing some strong performances there. Qualcomm rallied 12.8% after the mobile phone chip making giant said it expects a surge in smartphone sales next year thanks to a growing consumer appetite for 5G capable devices. Technology companies, in fact, were up across the board. Apple was up 3.6%, Amazon jumped 2.5%. While both Democrats and Republicans have ramped up scrutiny of big technology giants, the parties hold differing views on the problems the companies create and disagree on how to rein them in. That could potentially make it more difficult to pass comprehensive regulations, is what some of the investors believe. In terms of earnings, Alibaba fell after monthly mobile active users missed. Revenue came in just above estimates and adjusted EBITDA topped. Bristol-Myers boosted its full-year adjusted EPS view as revenue and profit surpassed. GM outperformed on strong demand for pickups. Uber's adjusted loss was wider than expected, but revenue from food deliveries more than doubled. Peloton beat on revenue and raised its sales guidance for the year, but shares slipped in late trading. On the FX side, US dollar traded sharply lower against all the major currencies on Thursday, with the Australian and the New Zealand dollars leading the gains. Risk currencies are up across the board, and 10-year yields, which sold off sharply on Wednesday, stabilized as well. This had nothing to do with the FOMC meeting, which had very little impact on equities and currencies. The Federal Reserve's decision to leave interest rates and the size of the quantitative easing program unchanged was widely anticipated. There were no surprises in the monetary policy statement as well. The central bank said economic activity continued to recover. Most of the statement was left untouched from September, but the Fed felt that financial conditions, which they previously described as having improved in recent months, is now seen as accommodative. Fed Chair Powell confirmed that the pace of improvement in the economy has moderated and that further support is needed from monetary and fiscal perspective. Meanwhile, the sterling soared after Bank of England's monetary policy announcement. The central bank left interest rates unchanged and boosted their bond buying program by about £150 billion, which was larger than expected. Yet the currency rallied because the central bank did not send any strong signals about negative interest rates, and the Treasury extended their coronavirus job retention scheme that could provide Fuller employees 80% of their usual salary for hours not worked for the next 5 months. So these announcements help, but overall the weak dollar definitely helped the sterling to move up much higher. That's the update. Have a lovely weekend. Stay safe and healthy, and I'll speak to you on Monday.